Hey there, we got a tough topic this month, but remember, please remember, we're all in this together. We're all here to try to help each other make money, okay? A wise man once said, best way to become wise is to have strong beliefs that are loosely held. Meaning, believe in something strongly, but if you see some facts that show you something different, then be open to that and possibly switch it over, okay? This is a very emotional topic, but I'm going to show you some facts, and then maybe we can help each other, okay? Now, first of all, how'd we get here, right? This is not automated strategies. This is not futures, Forex, or anything else, right? This is a completely different topic, and obviously we see a different theme. So how'd we get here? I love trading, love robots, love automated trading. Been doing it since 2013, okay? But as you know, if you've read the free newsletter or even watched some videos, I may have sprinkled it in. I absolutely lately hate losing. Can't stand a losing trade. Can't stand a losing month. Can't stand a losing 2 months. Can't stand it. I want to move forward. I don't want to wait for the drawdown to complete. I don't want to wait for new equity highs. I don't want to wait. I've got things to do, and I want to move forward. One of the famous books on self-help, 1% a day. How do you make 1% a day if you're losing trades and are in a drawdown for months at a time, right? Now, I get it. Trend following, for example, is the best trading strategy, the most verifiable trading strategy that's ever existed. The data's been around for hundreds of years. It's the most tested. It works over time. And yet, what do we know about trend following? We know that it wins about 30 to 50%, 50 if you're lucky, and it goes into massive drawdowns for months and years at a time. Does it pay in the end? The data says it does. What do we do today when we're losing? What do we do this month when we're in a trend following drawdown? And we got bills to pay. We have bills to pay, right? We've got things to do with our money. We've got no money. We've got less money. It's just been driving me batty. And this is me. This is me after a losing trade. I just can't stand it. So it's pushed me in the past several weeks, months, even about a year. It's pushed me in a different direction. What can we do to get over this? And guess what we found? Dividends. Dividends pay. Dividends move us forward. Dividends, if you have a bad month, still put money in your account. And amazingly, dividends grow over time. Some companies will pay you 1% this month, and then they'll pay you 1.2 the next month. Over time, dividends grow, which means your payments grow, which means there's less losing. And this is great. Except for the fact that the dividends that everyone recommends are in that 1 to 3% range. Nice, quote unquote, solid stocks. You're going to see a lot of quotes later. But they grow their dividends, which is great, right? But guess what the timeline is for a typically recommended dividend stock? 30 or 40 years. That's when it'll pay off. If you're 15 years old and do this till you're 55, numbers say you're going to have a lot of money then. Who in the world is going to do that? And even if there are, which I'm very happy for, I love success in any way, right? I love to see that. Do you want to do that? Right? 40 years from now, we might be able to live off our dividends. I don't know about that. So that in turn led me to high yield. There's been a plethora. There's been just an absolute explosion of high yield investments, specifically ETFs and single stocks. And these pay not 2 to 3% like we're told to like. They pay 20, 30, 50, 100%. Now, that's interesting. To see a dividend between 20 and 100%, that's life-changing. That's money into our pockets. That is moving forward. But guess what? Search around the internet, search around your YouTube. What are we told? High yield stocks are trash. Bam! They will throw you right in the dumpster. What you don't see is they also set the dumpster on fire, right? But my question is, are they though? Are they really trash? Well, let's talk about it. Now, if we stick to just normal dividends, whatever that means, well, I'm going to tell you what it means. If you stick to normal, that's okay. You'll have friends on the internet. You'll have friends all around you. Everybody loves to talk normal dividends. People are on board for that. You got the FIRE movement. You got the index funders who actually have a little dividends involved. Absolutely. But here's the thing. You're not allowed to want too much. You're not allowed to want high yield. Anything more than 3 to 5%. I mean, 5% is way above. 5% is kind of trash, right? Let's be honest. 5% is, a little risky there, Sporto. But let's say we go to 3 to 5. We're super aggressive, right? Anything more than that is unsafe because high yield is unsafe, right? Okay. Here's some facts. You know what a dividend king is? Look it up. A dividend king is the safest, best thing that we can invest in ever, according to some, most, right? A dividend king has not only paid a dividend for at least 50 years, count them, but they've increased dividends for 50 years. Nothing better than that. You put all your money in dividend kings. Now, aristocrats are almost as good. It's about half as long, right? I think it's 25 years. So as long as you stick to an aristocrat or a king, you put your money there, you go to sleep, you wake up in 46 years, and you're rich. Okay? Well, here's something interesting. LEG, Leggett and Platt, dividend king. They've paid increasing dividends for 50 years. And here's the stock chart. Yeah, 79% from peak to valley or peak to current. And that, my friends, is what you call NAV erosion. That's a key term. It's a key term out there. Learn it, love it. Net asset value erosion. This is a dividend king that pays a modest dividend and grows it every year. This is what the FIRE movement tells us to do. I know they tell us other things too. Calm down, FIRE. But this is a very high recommended stock. Leggett and Platt. Look, it's a value. It's a value. It's a value. I'm just showing you the chart. It's not my chart. It's its chart. Okay? That's horrible. How about those dividends? Every year it goes up. Until it doesn't. It's not gone. If you're counting on this, now you get this. Is that trash? Kind of seems trashy to me. Okay? And that's a dividend king. Let's do another one. Here's an aristocrat, MMM. They paid increasing dividends for 25 years. Put your money in MMM, get your Post-it notes out, and you're set. There goes the chart. Oh, look, though. It's rebounded. Is it anywhere near these highs? No. You would have lost money on a NAV eroding chart since 2021. Trash. But it rebounded. However, did the dividends rebound? No. Dividends were slashed. And they've stayed slashed. So there is the safe one, right? They paid you tiny little dividend, and then they cut it. Oh, and your NAV eroded, okay? Here's a dog of the Dow, another value stock, right? WBA, Walgreens, Boots Alliance, they're everywhere, on every corner, right? So many Walgreens. Now they're moving into pharmacy. They're expanding. They're doing great. There's your NAV erosion, okay? Dogs of the Dow, look it up. It's a strategy. It's beaten the market over 20, 30 years, depending on what you read, or matches the market at the very least. This is a safe, set and forget, go to sleep forever stock, and look at it. And it pays a little tiny dividend, under 10%, right? Which is not tiny, I know, but whatever. Yay, trash. Oops. Bye-bye dividend. Another example of dividend bye-bye. Okay? Well, let's just throw those aside. What if we read our dividend newsletter and it says, here's a smart pick, MPW. Go around the internet. This is a boring stock that just keeps cranking out dividends and profits. Yes, it fell during the COVID crash, but this is a stock you can have for, ever. What? This is my smart pick. This is my solid company that's been paying and paying and paying and paying and growing its dividend every year. You can put your money in forever. And not only did it slash it, not only is it missing stuff, it's falling. MPW is falling. MPW is falling. Right? Who you calling trash again? Right? And there's your Verizon, right? Down, 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 down. Still paying its dividend. Way to go, Verizon. But this chart shows NAV erosion. Dividend aristocrats and kings have NAV erosion, and more importantly, they don't pay very much. So you don't get paid, and the NAV goes down. Okay? These great, in quotes, reliable companies fell off a cliff. That is NAV erosion. And that's the number one thing you'll hear. Hey, it's too good to be true. Look at the NAV erosion. Well, I don't understand. Isn't that NAV erosion? Yes, it is. And they don't pay. Did I say that already? Yes, I did. So when we talk about a high yield ETF, you get NAV erosion, and that's the number one complaint. And yet the good ones can, right? Is there any solution to our net asset value falling, and our chart falling? Get paid more money. You ready? This is where it gets rough, right? Let's talk about Coney, C-O-N-Y. This is yield max, which is a bad word on somebody's vernacular, right? It is a single stock option income ETF based on Coinbase, which of course is the Bitcoin little dealer, broker dealer, whatever you want to call it. It's where you buy Bitcoin, okay? And that is your dividend rate. Now, dividends are actually called distributions when we're talking about income ETFs, so they're the same thing. Dividends, distributions are the same. 118%. I'm not 1.8%, where you get paid 4 pennies over the next 20 years. This is 118%. Can you hear the trash? Can you hear it? Everyone is calling this trash. Okay. What is it? I mean, is it too good to be true? Is it trash? Well, I'm not going to get into it. I can't stand detailed explanations on the internet or on YouTube about what a covered call does. Can't stand it, right? If you want me to cover it, I will, but I can't stand it. So boring. But it's a covered call strategy. It's synthetic covered calls. I get it. But it's just basically a covered call. No matter how you set it up, whether it's a stock or whether you buy in whatever. It's covered call ETF, okay? And it's on Coinbase, okay? Now, a lot of triggers in that sentence. You hear covered calls, you hear ETF, you hear Coinbase, everyone wants to freak. Let's just calm down. Let's get through this. What about that crazy yield? Is 118% fraudulent? No, it's not. And this is where we have to open our minds. This was, I think, Friday or over the week. It was a few days ago. All right. So it's relatively up to date. It's not exactly right now. There's Coinbase. I looked it up on my Thinkorswim. I want to sell a call, right, on about 7 days out. Okay. So it's pretty close, right? And there's in the money, right? And we're looking a little bit above at the money. So we might get some price appreciation. This is not aggressive. This is not crazy. But let's just say you and I are doing this. We want to sell a covered call. We bought the stock, and now we want to sell a covered call a little bit above price. Well, if we sell it, you can see that it's 7.55. Of course, we multiply that by 100, and that'd be $755. But this is actual Thinkorswim. This is from my actual platform. This is not made up, okay? This is something you and I could do. Here are the numbers. You saw that 755, and you saw it was a 7-day covered call. That's 755 times 4 is $3,000. That's per month, right? $3,000 per month for 12 months is $36,000 of premium. You get paid that every time. Every time you set this trade up, it goes into your trading account. Now, Remember how much we bought for coins? Get those covered calls? 17,925. So 18,000. Premiums are 36. We spent 18. That is a 200% ROI, return on investment, right? That came in and that's what we paid, and anyone can do it. So that yield is not just something made up, right? That yield is something we could do, and we're paying the ETF people to do it for us. That's it, okay? Now, what are the problems? All right, I'm sure you already know them. It's not going to pay $7.55 each time. It's not. It changes literally minute by minute. If things are hectic, they pay more volatile. If they're boring, it pays less. So you'll never get that same thing again. Plus, it's a pain. Who wants to sell covered calls every single week, right? Plus, the shares get called away, right? What if Coinbase rockets up, shares get called away? Well, we've made money, but we don't have shares anymore. Oh, no. We got to buy shares in. Oh, no. It's higher than when we bought it, so that's more money. Yeah, you can see where maybe some NAV erosion comes in, but we could do it. Just buy it back. Do it again. Who cares, right? Or the share price could drop and drop, and then we can't sell it for as much. We got to sell farther and farther out of the money, and we just can't make as much. We can't get as much premium, right? All of these things are a problem. All of these things are obstacles, but it's not fake. Anyone can do these crazy numbers. They're out there. It's just a matter if you want to do it. But does Coney, the covered call ETF or the income ETF, does it really pay? Here are some facts. Ready? This is where the rubber meets the road. I looked up every single distribution from Coney so far, all the way through October 16th, 2024. That was the price back when I looked it up, right around $20. And that was the price on 10/16/2024, right? It's changed since then, but bear with me, okay? We bought, hypothetically, 125 shares, so that's $24.60. Just a small little amount, right? Just a little. So let's say we just wanted to experiment. That was the distribution, and that's the distribution every month. Oh, it gets really high. Oh, it gets lower. It changes. It happens. This payout is this distribution times our shares, and that's what we hypothetically could have gotten every month. That's real. I don't know what to say. That's what's happened. I hypothetically paid $24.60, and if you add all those up, I hypothetically received about $2,700. Again, that's over 100% ROI. It's not fake. That's what would have happened. But what if we think about it like this? Here's another spreadsheet. Okay? Same thing. All the distributions are the same, right? Maybe stretch this out a little. Let's say we wanted it to pay a bill, and I just estimated a decent number. What if we have a $125 bill, okay? Maybe it's a phone bill. I don't know, electric bill, whatever you want to call it. And we want Coney to pay for it. We're not thinking about an investment or buy and hold. We're thinking about, I want to use this to pay bills. I want real life changes. I want to wake up and one of the bills in my life is gone, right? It's just paid for forever, theoretically, right? So $125 bill every month. That comes out of the account every month. This does not take into account taxes. You should take taxes into account, but let's just keep going. Payout was $151. The bill amount was only $125, so we had $26 of excess left over. Okay? Not using margin, not doing anything else. Next one, we had 10, right? 10 plus 26 is 36. This is just a running total. This one, our bill was $125, but we made $182, so now we have $219. This is assuming we didn't reinvest anything, just sits there. We bought Coney, we're paying our bill, and we're letting the cash sit. It's just one way to do it. Well, you can see us go to the end, right? We have excess every month, and we have, at the end, $1,000 left over, and this is still paid. Everything's been paid. Now, the stock went down. It did. It eroded. That would have been about a $600 loss in value. But the bill got paid, right? That bill that we wanted paid, it got paid every month. Oh, and we have $1,000 extra sitting there in our hypothetical account. So to summarize, the stock went down. Trash. The NAV eroded. Trash. I knew it would. And we have more money than when we started. How is that erosion? Exactly. How is that a bad deal? Exactly. If I came to you or someone came to me and said, hey, if you spend this amount of money, you're going to get a bill paid forever and you'll have more money than when you started. No. I'm going to say, no, that's terrible, right? Bill got paid and we got more money. Now, look at the stock chart. It's trash, right? It went up. It does go up, right? It's not like the others, or MPW kind of went up. But those were been going down for years. But it's been gradually cranking downward in the past several months, right? That kind of looks like the other ones. The difference is we make money on this, right? Is that crazy? We're making money on this. You saw what happened. And think about this, right? What if, considering the stock chart, we reinvested our shares? So we just use it as an investment. That's crazy. So every time Coney paid, we just bought more shares, period. Didn't do it. Didn't take any money. You with me? Since 10/2/2023, Coney's total return would be 75%, and the markets would be 34%. It doubled the market. This chart doubled the SPY. Doubled it if you reinvested. And if you compared it to J&J, how many times on the internet have you heard someone tell you to buy J&J? I am at 152,000 times. I've heard J&J, buy it forever. Dividends grow. It's the best. Coney, from August 15th, 2023, has returned 75%. Johnson & Johnson, if you reinvested, is negative 3.79. That's what we should do? Really? So let's wrap this up. It's a lot to digest. Yes, if you go toward high yield, the stock price will drop. Almost certainly. Not always, but just plan on it. And yes, the distributions could change every month. And yes, they could change the prospectus. Absolutely. They can do anything they want, right? Again, the distributions could change every month. It's worth repeating, right? That freaks people out. I want to count on it. I have a budget. I don't want them to change every month. I have bills to pay. But guess what? If you're an MMM, it changed. It wasn't the same every month. It went down in half. Or sometimes it goes away altogether. Do distributions change from dividend kings and aristocrats? Yes. And we need to deal with that. It's true. So the summary is this. If Coney is trash, dividend aristocrats are trash. That's crazy, right? That's crazy. But if we're comparing Coney and dividend aristocrats, one of them actually can pay the bills. One of them can actually change our lives starting next month, assuming they don't go to zero, of course. What do you think of that? What do you think about this craziness? Something to think about, right? If you want me to talk more about this, that's fine. I know it's different than my typical videos. I'm doing this to a portion or a big portion of my portfolio. I'm doing it. It might crash and burn, but I'm doing it. If you want to hear more about it, I appreciate you letting me know. But let's get to the speed round. Look at that's fast, all right? Please like and subscribe. I want to get to 1 million subscribers. No, I would love to have you like and subscribe. I hope you enjoy it. Website is changing. It's almost ready. This is kind of what it'll look like. You'll still get the automated systems, but you might see more stuff like this too, right? Nothing's gone. Nothing's happened with the robots. They're all still there. There are 2 books. I'm thinking about more of those actually too. Here's some contact information. Scott@scottwealthstrategies.com. Website, Twitter, YouTube channel, and so forth. That's the video for this month, everybody. Hope you found it interesting, and I hope it didn't make you angry. Bye for now.